Hello, Mark Sturdy here with another summary of our work this week, with 7 days ahead looking at major world markets, major liquid world markets. And if we look at our summary page, you will see that once again, unusually, we remain one step back from the market. We think there's no clarity in all time frames in any of these markets yet. Things are happening, which we will look at, but that there is no congruence, you might say, between the short, the medium, and the long-term charts. Let's start with our usual dollar-euro survey, and you'll see that the market really remains dollar bullish. The reasons it's dollar bullish, we've often talked about, are the breakout from this parallel channel and the completion of this triangle. The double completion led to this initial dollar strengthening, the pause, the pullback to test the bottom of the parallel channel, and we remain just below that parallel channel, butting up against, notwithstanding the recent weakening of the dollar, bringing the market back up. It remains butted against this channel and the bottom of this triangle here. So as regards the big picture, we remain dollar bullish unless and until this large situation breaks down, which it hasn't yet. Let's look in slightly more detail. You'll see that the weakening of the dollar over the early days of the Trump administration is clear, but that it's nonetheless falling back into a trading range rather than breaking out of one. We can see that the catalyst for that dollar weakness was the completion in the day chart of a head and shoulders reversal, but that's largely exhausted itself. So we stand back from the dollar-euro. Just a quick word on the sterling-euro. You will see that we noted and have noted several close approaches to the top of the trading range from 2016, and we remain very close to that extremity, but that the market has pulled back from it, and without great clarity, without really establishing a top formation, so that we once again, like the other markets, we're in a trading range. Stand back. If we move to the S&P 500, another vital marker of the charts, we will see that the large long-term bull run remains intact. We have, however, completed a small top formation, which looks to be intact, notwithstanding this retracement back to where you'd expect to find resistance if the top formation was intact, and it did rally back and failed. In so doing, it created a weekly key reversal, which we can see opens lower today. We need a break of 55.59, I think, to get the bears going again. Good to remember as well that the implications of this top formation have largely been exhausted. There is some more to go, you could argue, but that it would be running out of steam. So nonetheless, for that, we see 55.59 as an important marker of whether the market wants to go lower. The same is not true so much in the European markets and the other markets. It is worth remembering that these, for example, the S&P 500, the Eurostoxx 50 is at and tested this prior high from the 1990s, 5,500, and is pulling back from that. But unless and until this market, the Eurostoxx 50, can break down through these prior highs, it can't really be considered to be in a vulnerable situation. Watch then for a break of 50.79 to look for the next important move there. Stand back. FTSE, well, we've long argued that this is a bull market from the completion of this triangle and a bull market from the completion of this head and shoulders continuation pattern, both of which remain intact, and therefore, notwithstanding the slight pullback and drift, we stand back. Nikkei 225 is nothing more, rather like the Eurostoxx 50, is at a major prior high of 1980, 39,600. That is important, and the failure to break up through that is important, but you couldn't regard this as in any way vulnerable unless 33,950 was broken, or better still, 3720 beneath the market. Bonds are equally complex and lacking clarity in all time frames. The US Treasury note has been zigzagging sideways for some while. since early November when Trump came in, it is largely unchanged. It's gone higher yields, lower yields, and it's not quite clear where it's going to go from here, to be perfectly frank. There is an argument, a very short-term argument, that the market wants to go for higher prices, lower yields. We'll see if this little triangle is sustained and has any clarity. And if, for example, it did that, it might be the catalyst for this yield chart to break beneath this possible neckline and create a head and shoulders top from very much lower yields. Unless and until that happens, this neckline is broken, we stand back. The German Bund going sideways under the 3 level where it got to some while ago. It's a sideways situation lacking clarity. Some suggestion that it might be dropping back through this 2.7 support. We'll see at the end of this week. Oil, trading range again. Look more closely. Here's the medium-term weekly chart, trading range. And gold, well, there is a trending market. But the point about this trend is it's gone at least as far and beyond the minimum measured moves for this triangle and this continuation pattern. So it is an overextended market. It's moving, trending swiftly, but subject to and vulnerable to setbacks. Thanks very much.